Hi, I'm Doug Knoll, and in this video I'm going to give you my review of Regal Assets Gold IRA. At the end of this video, get my free 10-part training on how to invest in gold and get your free precious metals investor kit from Regal Assets. Some disclosures. First, I'm an investor, not an advisor. My opinions are my own. And I have an affiliate disclosure. Financial Freedom is my professional review YouTube channel. I may receive compensation from the companies whose products I review and recommend. Financial Freedom is independently owned by me, and the opinions expressed in this video are mine alone. Although I do my best to be objective, my recommendations may not be neutral or independent. And of course, be sure to investigate, ask questions, and seek professional advice on any investment decision you are contemplating. In a moment, I'm going to show you why I have moved out of the stock market and into cash and gold, because what I see coming is very scary. But first, what I like about Regal Assets. The customer testimonials are amazing. Regal Assets is transparent about its fees and costs, and you can get started online with a minimum of fuss and bother. It's really simple. So let me read you some of the customer testimonials that I've seen. I so much appreciate the professionalism and experience that I received while rolling over my IRA to precious metals. I strongly recommend Regal Assets for your precious metals purchases. I looked into a couple of different companies to do business with and made a decision with Regal Assets. I couldn't be happier with my decision. Having taken a financial bath during the last stock market crash, we researched who was best qualified to advise and guide our financial planning. We found Regal Assets had some of the best reviews and engaged them to help give us some clear direction in navigating the tumultuous waters of the stock market. Having had such a positive experience that we did with Christian Howard and Regal Investments, we would highly recommend them to anyone in our same financial position for guidance to hedge the inevitable drop in stock market values. Regal Assets is also very transparent about fees and costs. So you can see that the initial setup fee is waived. There's an annual administration fee of $100. An annual storage fee per $1,000 of investments of $15, a minimum purchase of $10,000, and the preferred depositories Brinks Global Services. Setting up a Regal Assets self-directed gold IRA is very straightforward. Well, are there reasons not to invest in a Regal Assets Gold IRA? And of course there are. Let's kind of go through some of those. First of all, you may not have enough money in your traditional IRA to be able to invest in gold. The minimum investment with Regal Assets is $10,000. So if you desire 10% of your IRA to be in gold, you would need a total investment portfolio in your IRA of $100,000. Although everyone is different, investing in a gold IRA should be a prudently small percentage of total portfolio value. You believe the stock market is forecasting accurately. A gold IRA only makes sense to hold value, not to make money. If you believe the stock market will continue to rise in value, gold is probably not a good investment for you. You want liquidity. A self-directed gold IRA could limit your liquidity, especially if you're closing in on the required minimum distribution age of 72. You may not want to risk commodity price volatility. Gold is a commodity like wheat or corn or soybeans. It's not a security. Its price fluctuates with supply and demand. Gold prices tend to go up when stock prices go down, and vice versa. So cashing out of gold in a price drop may cost you more than you made in a rising market. However, if you're allocated properly, even if you lose money in gold, the rising stock prices should more than compensate for the loss you suffer in gold as a hedge against a dropping market. Earlier, I said we would cover why I have moved out of the stock market and into cash and gold. So here are the stages in a stock market bubble. As you can see, there are 4: stealth, awareness, mania, and blow-off. And you can see how the market slowly goes up until we get to the later stages of the market where it escalates rapidly. You get to the top of the market where there's a new paradigm, we're all going to be wealthy, and then it crashes a little bit. People go into denial, it hits a bump at the bottom, the bull trap, and then there's a bull rally, and people think, oh, we're returning to normal, really not a problem at all. And then there's a precipitous drop-off. This is the pattern that the stock market has followed throughout the 20th century and now into the 21st century. And what drove me out of the market and into cash and gold is this. This is the S&P 500 for up through middle of 2020. And you can see that it eerily patterns the classic stock market bubble pattern. And when I saw this, I said, I think we're in for a big drop. And so I got out. There has been a strong bear rally from late March to early June of 2020, and this has been fundamentally driven by the Federal Reserve's quantitative easing policies. But there's a problem with that. The problem is that it's a false distortion. I would personally rather be in cash and some gold because I believe the stock market has been grossly overvalued since 2010, and in recent months, with a complete collapse of the global economy because of the pandemic, the Fed is doing nothing but kicking the can down the road. And I'm not alone in this thinking. Beware not just of zombie companies, but of zombie markets as asset prices become distorted and detached from fundamentals, warned Allianz chief economist advisor Mohammed El-Arian. Zombie markets are markets that are completely mispriced. They're completely distorted, El-Arian said. Why? Because there's a policy view that you need to subsidize everything in markets for now. The market feels very strongly that it basically is holding the Fed hostage. So the effect of quantitative easing is to grossly overvalue a stock market that, if it were operating in a proper market, would be dropping rapidly so that companies that are inefficient would be going bankrupt. They would not be getting, for example, junk bond loans to keep them going. And what we have here is a federal quantitative easing because the political risk of a stock market crash is too great, and nobody wants to see the economy collapse when that's exactly what must happen in order for there to be growth in the rest of the 21st century. Well, you can draw your own conclusions and make your own decisions about all of this. If this was useful and informative, click on the link below to sign up for my free 10-part training on how to invest in gold and get your free gold investor kit from Regal Assets. So be sure to click on the link below, and here's the URL, and we'll see you later.